And we are live from Bloomberg's World Headquarters in New York. I'm Shonali Basak.
And I'm Tim Stenevec. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance.
And coming up in just a moment, we're going to be speaking with the former chair of the CFTC, Rostin Behnam, as a new era for crypto in D.C. takes hold.
Plus, we're going to speak with the newly named CEO of 21 Capital, Jack Mallers, as Cantor, Tether, and SoftBank team up to form a company to buy Bitcoin.
And we're going to also catch up with Franklin Templeton's head of innovation, Sandy Kaul. She's going to discuss stablecoins and opportunities within tokenization.
That's all ahead on Bloomberg Crypto. First, though, a check of Bitcoin and the whole market. Just going back the whole year, look at this. Bitcoin's actually higher year to date, despite all of the volatility, ever so slightly up about 1.2%. Just this month, it's really surged past gold and tech stocks. It's kind of rekindled this debate over whether or not Bitcoin is a safe haven. Most recently, during the volatility this month that was triggered by President Trump's tariff policy. So over that time, the NASDAQ is roughly flat since so-called Liberation Day. The Bloomberg Dollar Index is down around 4%. Gold is up about 6.1%. Bitcoin, though, look at that. It's up about 11%, a little more than 11%. It is still down about 11% from those all-time highs around Inauguration Day. But Shonali, it's had quite the month.
Quite the month. We are flirting with 95K, and 95K looks good for BlackRock. We're going to look at the flows for IBIT. Bitcoin ETFs have seen more than $3 billion in inflows in recent weeks. And of course, that is a nice reversal from February. We are back here in the green, Tim, for that ETF industry.
Well, just last week, speaking of the industry, U.S. bank regulators withdrew guidance on crypto sector risks, giving lenders more freedom to delve into digital assets. Let's discuss with Bloomberg's crypto editor, Mike Regan. Mike, what exactly changes here?
Well, you have to remember what this guidance, where it came from. If you think back to 2022 and then into early 2023, you had two major events. Just the collapse of the crypto lending market after FTX imploded in 2022. Then you had those serious issues with some of the regional banks, specifically Silvergate in the crypto space, a very crypto-friendly regional banks. So the banking regulators back then were very worried, and they were keeping a close eye on banks to see what kind of crypto business they were involved in, and not just the big banks, but a lot. I think they were especially worried about these smaller regional banks like Silvergate, Signature, Silicon Valley Bank. Crypto didn't exactly precipitate that crisis, but they were somewhat crypto-friendly. They really were trying to warn banks basically away from crypto at that time. So now what they're doing is removing that guidance, and the Fed had basically told banks to seek prior approval before getting into business with crypto companies.
Mike, does it really create a change? If you had the top banking watchdogs take such a strict stance before, is it really going to unlock a wave of banking activity, or are the banks bound to be cautious anyways?
I think they'll still be cautious. I mean, they're all too familiar with sort of the risks that the regulators had warned them about, liquidity risks and the volatility risks. The problem being, if there is a massive collapse in crypto prices, will some of these companies need to raise some money and have a sudden withdrawal of funds from the banks. So I think most banks are very aware of these risks, but it certainly takes the restraints off them to some degree, where they don't have to go through all these hoops and fill out all this paperwork and basically get the permission from regulators like they did. They're going to be more left to their own risk management devices rather than the FDIC and the Fed. So I think it does, potentially create some new risks. Not necessarily major risks right away, but it depends which banks get aggressively into crypto and what sort of mix their business is, how heavy it is into crypto versus everything else.
And in what way? That is Bloomberg's Mike Regan. We're looking forward to your coverage from you and the team for the rest of the week. And joining us now, former CFTC Chair Rostin Behnam, who I'm speaking with later today in an event hosted by Georgetown Saros Center, talking a lot about the future of financial regulation, also with Patrick McHenry as well. Looking forward to that conversation, Russ. Now, you look at the way regulation is changing before our eyes. You were very, very involved in the future of crypto when you were serving as chair of the CFTC. My main question for you is, what really changes? To the extent that you are looking for clarity for rules of the road, what is going to be the biggest change in the next 4 years?
Sonali, thanks. And it's good to be with you now. I'm looking forward to the conversation with Patrick in a little bit later this afternoon. Hopefully, a lot of folks will tune in. Elections have consequences, so we're going to have new officials. We're starting to see new officials step into their roles in a permanent position, certainly at the SEC. Shortly, we'll see that at the CFTC and some of the bank regulators, too. And, when I think and reflect back on my 4 years at the CFTC, and specifically those 4 years relative to the maturation and the development of the crypto ecosystem, there was a lot going on. There was booms and busts, and I think there was a challenge by policymakers, elected officials, to really wrap our heads around what was happening, the sustainability and durability of the technology, and what the future would hold. And I think over the 4 years, there were a lot of really positive efforts from Congress and regulators as well to get a sense of how crypto could potentially fit into the financial ecosystem and traditional finance. And right now, with new leadership, both obviously in the White House, Treasury, and new members of Congress, and then obviously regulators too, you're seeing more of a concerted effort to bring rules of the road and policy around the space. And that will naturally change depending on who's in charge and what direction they want to take it. And there will be some areas that don't necessarily need new legislation from Congress. But as I said many, many times before, and to you in multiple conversations we've had at events and conferences, there are certainly gaps in regulation that are needed to be filled by Congress, and hopefully that'll get done in short order.
Yeah, certainly I think a lot of people who watch the space closely echo what you're saying about maybe an understanding or viewing of regulation that becomes more clear. I'm wondering if you've seen anything happen thus far in the first 100 days of this administration when it comes to the crypto space that gives you pause, that says, wait a second, I wouldn't have made that same decision, or I don't advise that that is necessarily a healthy thing to do for the markets.
Yeah, I mean, in this environment where you don't have comprehensive regulation for the regulators, and there are some gaps, which I've said are certainly around the commodity tokens, and some rules probably need to be tightened up around the prudential regulators, the banking regulators. And I think in these moments when you don't have full rules of the road and comprehensive regulation and comprehensive authority, it's absolutely critical to use as much of the law enforcement authority you have to ensure that markets are safe, that customer money is protected, and that the individuals who are participating in these markets have as much information as possible. There's naturally going to be a little bit of a filter when you don't have comprehensive regulation. So not as much information flow is getting to investors, retail or institutional. And I think, to the extent that the law enforcement agencies that are both market regulators in some respects, but also banking regulators as well, are using the full extent of their enforcement authority to police markets, to protect customers, and to make these markets as safe as possible.
That policing ability, what do you make of it in this current era? Of course, there's been a lot of talk around the impact of those Doge cuts and what it means for agency officials to do their job or to go after companies that might not be behaving in the current rules and structures. Do you worry about that?
Absolutely. And, look, I had budget challenges as any chair has at any agency. You never have the budget you purely want. And I think that would be a rare situation if an individual did have the budget they requested. But you have to work with what you have. And in this environment where there are many federal employees being laid off or leaving for multiple reasons, I do worry because this is institutional knowledge inside the agency. These are the individuals who are hardworking and trying to make sure markets, I'm going to speak from my perspective as a former market regulator, whether it's registering the exchanges or the intermediaries or the clearinghouses, the new products that are emerging at a rapid clip, facing new novel questions. We need as many people, good people, as possible. Now, there's always room for cleaning up and efficiency and making sure we are using taxpayer money as well and as efficiently as possible. But it's also important to see and understand the importance of market regulators. I say this often, and I will continue to say it even though I've left the government for now a couple months. U.S. capital markets are the best in the world because of the regulation we have, because of the rule of law we have. And I understand things need to change around the margin. It's never perfect. And that's the relationship between Congress, the agencies, and the market participants lobbying and advocating for different types of rules. But we need to ensure the market regulators are well-staffed, and ready to protect markets.
Well, on that relationship and protecting markets, I had the chance to speak with acting chair of the CFTC last week, Caroline Pham, and I asked her specifically about the president's proximity to crypto, specifically with regard to the meme coins that he has, World Liberty Financial, the dinner that he said he's going to host with the top holders of the meme coins. I asked her to weigh in on that and if that made her job more difficult. She said, "My job is difficult every day. It doesn't make any difference." And I'm curious how you view her role there, or not necessarily her role, but the role of somebody as CFTC chair and the proximity that the president has to this industry, given he has a hand certainly in regulating it.
Well, again, having been in that position and knowing the very clear rules around ethics, guidance around ethics, and what conduct is either permissible or prohibited for any government official. So this could be, an elected official, an appointee like myself formerly, or any staff at any agency. There are very clear rules of the road around what activities are permitted and prohibited. And they do, differ depending on the agency and what exposure or what business or conduct the agency involves. As you can imagine, whether it was crypto, energy markets, traditional financial markets, agricultural markets, there was a number of prohibited activities that I was not permitted to do, and currently CFTC employees are not permitted to do or conduct themselves. And I would just say it is important, with these rules being very clear, that the market regulators, that the Justice Department, so civil or criminal, are looking into these issues if there are issues. And I don't want to jump ahead and suggest there are any, but it is important that we have these mechanisms, whether it's the judiciary or a legislative branch, to utilize its oversight function. It's just important that all of the branches of government are using the full extent of their powers to make sure that there are no violations of law, specifically around ethical issues.
Tim and I have been trying to understand exactly, it's not just the president, it's the president's family as well that is very closely attached to the crypto industry. What are the guardrails? I mean, how does this all work when you have a president that is so closely aligned to the crypto industry and his family, with financial interests also so closely aligned?
Sonali, the rules they apply to the individual who's in the position in the government and potentially family as well. So I'll just repeat what I said earlier. The rules are very clear around ethical permission and prohibitions. And it's important that elected officials and their families follow these rules. And then it's equally as important that our law enforcement are enforcing these rules if they are violated or if there's any suggestion of violation. So as I said, it's important that all mechanisms are working and firing on all cylinders, but the rules that Congress wrote, the law that Congress wrote, and the rules that were implemented by multiple agencies to ensure that government officials are not abusing their power are clear. And it's just important that we utilize the powers of the Justice Department, the market regulators, to ensure that any bad conduct, if it is in fact happening, is exposed.
It is a new era, and certainly just the beginning. That is former CFTC Chair Rostin Behnam. He's going to join me and former Representative Patrick McHenry for a webcast with Georgetown University's Sparrow Center at 1:30 New York time. You can watch it if you have a terminal on Live Go.
Well, coming up, Jack Mallers is in charge of a SPAC accumulating Bitcoin similar to Michael Saylor's strategy. He's joining us right after this. Data on news on crypto. Check out CRYP Go on the terminal. This is Bloomberg. Well, Cantor Fitzgerald, Tether, and SoftBank have teamed up to create 21 Capital via SPAC. It will accumulate Bitcoin in a similar fashion to that of Michael Saylor's strategy, with plans to launch with more than 42,000 Bitcoin worth about $4 billion. Jack Mallers will serve as CEO, and he joins us now. Jack, good to see you. Thanks for joining us today. How exactly is the strategy at your firm going to be different than what Michael Saylor has done over at Strategy?
Yeah, well, good to see you too. Thanks for having me. I would say the hole in the market, or the opportunity rather, that we've identified is to be a pure play Bitcoin business. We want to be the ultimate vehicle for the capital markets to participate in Bitcoin. And so that's not only accessing the capital markets to raise accretive Bitcoin denominated capital and grow something like Bitcoin per share through fundraising, but also building Bitcoin native business lines and business models. I think, as Tether and myself co-founding the business as partners, we have a lot of experience and success in our other business ventures in finding high margin, high growth opportunities. And we hadn't seen anyone that was using access to the capital markets, access to a massive Bitcoin balance sheet, extend that opportunity beyond just buying Bitcoin and actually building on top of Bitcoin. So we are a Bitcoin business at our core. It's at our founding. It's in our name. It's on our board. It's at our leadership. We build Bitcoin products. We're focused on Bitcoin cash flow, and then obviously an ability to accumulate Bitcoin through capital market fundraising and grow our Bitcoin per share. So we are as pure play a Bitcoin opportunity in the capital markets as we think exists, and that is what sets us apart from everyone.
One question I have about this and comparing it to strategy, I'm sure you've been getting that a lot over the last week. You mentioned capital markets. How far does that go? Would you raise a lot of debt? Would you do other things in terms of capital raising to acquire that Bitcoin? What types of folks are you in talks with for that?
Everybody. Listen, my goal as the CEO of this business and my mandate and message to our shareholders is, in a hypothetical, and my intent is to grow your Bitcoin per share. What makes 21 extremely unique is we're an operating business. When you're investing in the business and you're buying a share of the company, you're investing in leadership, in folks like myself, to go out and work for you. And what that work results in is, let's say in a hypothetical sense, we have 0.05 Bitcoin per share. And shareholders, that's the amount of Bitcoin on our balance sheet representative of a share in the business. Our goal and our intent is to be able to grow that to 0.06 Bitcoin per share, 0.07 Bitcoin per share. So it's a vehicle in the capital markets where $1 into an operating business like 21 goes far further than $1 into an ETF like IBIT, because you're investing in an operating company that's going to go out and execute. And what I'm executing and focus on is that Bitcoin per share metric. So any opportunity, whether it's a product we can launch in the market, whether it's a relationship we can build as partners, whether it's capital market access, and that's the fixed income market, whether anything I can do, I am dedicated and sold on growing Bitcoin per share for the capital markets. That's my job and my commitment.
It's a good thing you're on Bloomberg. The capital markets bankers, I assure you they are listening. But let me also ask you.
Hello, bankers.
Yeah, they're out there. But beyond that, you have been able to look at all the ways to think about Bitcoin, particularly through payments. Now, one question I have is, when stablecoin legislation really takes off here in the United States, stablecoins then become another way to transact in a very efficient and very low-cost way. I've seen payments via stablecoin networks close to zero in a lot of cases, right? So what's the point of transacting over Bitcoin if you can just do it via stablecoin?
Well, Bitcoin and stablecoin carry tremendously different properties. Bitcoin is censorship resistant. It's neutral. It has no controlling entity, controlling government, controlling bank. That's not true for stablecoins. And so we view Bitcoin as a neutral reserve payments protocol, as it's like a public utility for the world. No one can stop you from using it. No one can negate access to it. Now, stablecoins are entirely different and serving an entirely different market and customer. A lot of the stablecoin users around the world, the stablecoin like Tether is actually competing with their local fiat currency, not necessarily with Bitcoin. These customers own Bitcoin and Tether instead of Bitcoin and Naira. And so we think of them as two entirely different products serving two entirely different use cases, but most importantly, they have very fundamental different properties. What we believe Bitcoin serves to the world is an open value transfer protocol that isn't owned, governed, or controlled by anyone. And that's not true for any stablecoin that can exist, because at the end of the day, they're representatives of a nation state currency, no matter what stablecoin it is.
Jack, gonna have to leave it there, but always good to see you. Thanks for joining us on Bloomberg Crypto. That's 21 Capital CEO Jack Mallers. Well, coming up, Franklin Templeton's Sandy Kaul, speaking of stablecoins, says banks will soon issue their own stablecoins. We're going to discuss with her right after this. This is Bloomberg.
Now, Meanwhile, Franklin Templeton is keeping a close eye on stablecoins, with Standard Chartered estimating the asset class is worth $200 billion. Franklin Templeton's Sandy Kaul says, quote, many banks are likely to amend their business models and become issuers of their own stablecoins, and this would allow them to replace lost earnings on deposits with collateral pool yields. Let's discuss this with Sandy right now. This is fascinating. We have heard large banks float the idea of it and even toy around with the idea more and more. You think about JP Morgan early around, really thinking about ways to use blockchain. What changes in the banking model from it if they can pursue this at greater scale?
Yeah, the biggest change that we can expect here is that we're moving from an account-based structure world where you have multiple ledgers, each bank having its own ledger, each bank really needing to administer its own set of clients individually, to a single ledger blockchain-based world where you operate out of wallets. And stablecoins are really proving to be the killer app of this new ecosystem in terms of creating the flow of capital that is keeping this wallet-based ecosystem operating. And what we're starting to see is that the major banks are starting to understand that the opportunity space is shifting. More fiat currency is getting locked into stablecoins. Those stablecoins are staying deployed in a wallet-based ecosystem, and that's creating this fuel to really allow for a growing set of transactions to occur on-chain and out of the traditional economy.
So what would this replace, Sandy, that banks currently use?
So this is replacing a lot of what we usually see moving in and out of our checking accounts. You can almost think of the stable coins that sit in my digital wallet as my on-chain checking account. And it is allowing more people to remain fully out of the fiat banking system and using just stable coins, because the same stable coin, which is backed by a dollar, let's say, can circulate over and over and over within the blockchain wallet-based ecosystem without ever getting cashed back out to a dollar in the regular real-world economy.
Sandy, gonna have to leave it there, but you got to come and join us once again. That's Franklin Templeton's Sandy Kaul. That is going to do it for Bloomberg Crypto. Join us again, though, next week. This is Bloomberg.